Anton, welcome back. I know you tend to focus on the smaller and mid-sized banks, but of the gigantic, massive banks that we just mentioned, is there one that you either like or are watching more closely than the others?
Sure. I mean, obviously you like JPMorgan, but it's pretty close to fully priced. I mean, it was a great quarter. They put up fantastic numbers and everything just clicked. And that always sets a high hurdle for all the rest of the banks that come through. We own Wells Fargo. It's a self-help story, and they needed some help. They've got to get through all the regulatory issues. They've got plenty of capital. They need to be able to grow. And once they're able to grow, their earnings will move a lot to the upside. And I think what's really important in this banking space today is how much capital the banks have and how much of the asset side of the balance sheet is in really short-term investments that's yielding almost nothing. So the ability for the banking space to make a lot more money isn't just predicated on a steep yield curve. It's predicated on being able to deploy all of that cash, all those short-term securities into loans. And I believe loan demand is going to pick up substantially as we go forward, as America sort of works off all this cash from all the stimulus that it received, from the federal government. And there's still a lot of cash on everybody's balance sheet, on corporations' balance sheets, on individuals' balance sheets. All those programs are very successful for helping the economy, but it's also fuel for the economy to roar forward. We need to get people back to work, and that will be really important because manufacturing wants to hire people. They want to put out new lines. They want to re-domesticate different products. It's very important to the growth of this country, but if you can't hire people, you can't open new lines, and that's really important. Let's get people back to work.
Yeah, and outside of the big money center banks that, Goldman, they're basically a trading firm with sort of a bank inside of it as well. JPM, Morgan Stanley, kind of the same way. Then there are just banks, the ones that we see on our corners. Their business is not complicated. They take deposits, they make loans, and they try to make money on the difference and hope that everybody pays back those loans. Many of those companies, the ones that you own, Anton, have had spectacular years. I don't know if you own these. I'm just going to throw out some names. Western Alliance Bancorp, East West Bancorp, Valley National Bancorp, right? The ones that we see in our hometowns. Some of these stocks are up 70 and 80% in 2021. How much more do some of these smaller names have left in the tank, so to speak?
Well, as I mentioned before, earnings estimates, I think, are still too low if loan growth returns. I believe it will return. I continue to like to hunt in places that have above trend growth. So places like Tennessee, places like Texas. In Tennessee, First Bank, FBK, and Texas, Veritex, VBTX, they're both going to have very good growth this quarter in loans. And that's really critical to be able to deploy that. And yes, the returns have been spectacular this year, but what's important is how badly these stocks performed for multiple years. And obviously, particularly, they performed very poorly in 2019 and through all 2020, really. And this is just a comeback. And now we're basically still at a big discount to the S&P, at a discount where some of these banks historically traded. And I believe the earnings are going to be far above trend and will grow faster than a lot of companies in the S&P as we move forward. I believe this is the roaring 20s. I think the economy is going to be pretty strong for the next few years. There's so much fuel here. So as we replace the cash, eventually debt will return, and the debt will be loans in the forms on the bank balance sheets. That will allow those banks to grow earnings substantially. Now, if the Fed starts raising interest rates, okay, everybody plays that trade all the time. And when short-term rates rise, sure, a lot of these banks lend on a variable basis. And yes, earnings will go up from that. But to me, the real thesis here
rates
is
have to rise.
Growth. No, they don't. I mean,
rates, Anton, have to rise for these banks.
Well,
is there a level at which they go up and it's going to harm them? I mean, is 2% good for them or bad for them? 2.5%. If we get there.
Let's look at history. I mean, rates haven't been here, right? I mean, they're here over the last few years. They haven't been here. I mean, banks made piles of money when interest rates were, 5-6%. So, you really don't need to have rates go to 2%. I think if rates go to 1 or 1.5%, again, you'll see estimates go higher. So it's not just the loan growth, that will help too. Obviously, a steeper yield curve helps. It's not as critical day to day. The market gets very myopic and trades these things day to day. But the reality is, this is over time. A bank's balance sheet doesn't run off or get replaced on a daily basis. The market tries to trade that way and say, okay, the 10-year yield is 154. That's where it is. Well, okay, it's it's here today, and it's really where the expectations are. I certainly see inflation. Everybody sees inflation. Every bank executive sees inflation, and they're as close to it as they can get, right? Because they're lending to customers who have to pay for goods,
Yeah.
have to pay salaries. Salaries are not transitory. They will not be for quite some time, because you want to get those people back to work, you've got to pay them.
Yeah.
And it's just reality.